I'm attorney Lewis Haskell, sitting downstream from the Thác Mok waterfall in beautiful Chiang Mai, Thailand. And I want to continue my series of videos about the new 20% deduction for pass-through entities. And this time I want to talk specifically about its impact on real estate investors. And its impact on real estate investors is extremely favorable. And what I mean by that is, first of all, it includes almost all of us. And what I mean by that is, although it excludes real estate held by C corporations, it includes real estate held in LLCs, in subchapter S corporations, in pass-through trusts, and frankly, real estate held in own name, where you just simply file a Schedule E at tax time. So pretty much all real estate investors are covered by this. By the way, it also covers real estate investment trusts, although I don't represent any of them. But in any event, so it covers a very wide range of people. And what it does is it makes 20% of your qualified business income from investment in real estate. It deducts 20% of your qualified business income from the investment in real estate from your taxable income. And so that can be very sweet. If you make $100,000 in real estate, not paying tax on $20,000 of it is a pretty good deal. Now, there are some exceptions to that, the most important being that your capital gains from investment in real estate are not subject to this 20% deduction. So those are treated as they have always been. But for regular income from real estate, you're fine. And keep in mind that when you write off depreciation for your real estate, that number that's left, that number that you report on your 1040 form, that's your qualified business income. Depreciation, like everything else, is a qualified business expense that comes out of your revenue in the calculation of business income. For most small real estate investors, you basically have now heard everything you need to know. There are, however, some limitations on this deduction, and those kick in for people whose taxable income is more than $315,000 if they're married filing joint, and $157,500 for everybody else. At that point, this 20% deduction may begin to phase out over a range of $100,000 for married filing joint and over a range of $50,000 for everybody else. I say may because there's a very important provision in the new act. It actually was added in the end, and it's kind of sweet. For people who are beyond the phase out, okay, so let's say you have $1 million, in adjusted gross income, some of which is qualified business income from real estate. What you would do on your real estate investment is take 2.5% of your depreciable base in the real estate or in your property. So it could include things that are not real estate. So long as either you are still depreciating them or you put them into service in the last 10 years. Now that latter provision is important because, for example, say you have purchased equipment that you have put it, like an HVAC system, for example, that you put into the property and have depreciated over a shorter period of time than 10 years, you still get to use it as part of this calculation I'm about to do for the next 10 years. So let me put this in real numbers. Imagine that you bought a building for $1 million and you bought it, recently enough that you're still depreciating it. You would be allowed to take a deduction of up to 2.5% of that million, or $25,000. Now, for a lot of people, that's going to mean that even when you make a lot of money, have a large taxable income and are subject to a cap, that your cap is still the full 20% or something close to it. In this example, your cap is $25,000. Maybe you have qualified business income from that real estate of more than $25,000, and maybe you don't. But if you don't, then you get it all. Now, the phase-out rules for this are a little bit complicated, but to make a long story short, you take your 20%, which is what you get at the $315 for a married filing joint. You take whatever that 2.5% would be, and by the way, you also get to add something else on to that, which would be 25% of whatever wages you're paying as part of that business income. Now, with real estate, you don't always have wages. In fact, usually you don't. But if you do, so much the better. So in any event, you take that number that's just the 20%, you take that number that is the 2.5% that you would have if your taxable income is over $415,000. And you kind of have a sliding scale. So, if you're at 365, so you're halfway, 50,000 more than 315, you would take you would take kind of the average of those two numbers, and that would be where you are. But in any event, that's kind of how it works for real estate investors, and unless you make a lot of money and you have real estate that you bought, 40 years ago and can no longer depreciate, it's going to be a sweet deduction for you pretty much no matter what. So, I look forward to working with people, because a lot of my clients are real estate investors, including my most important client, my wife. So I'm really looking forward to working with this particular deduction, because I think it's going to mean a lot of money for a good number of people. Well, thank you for watching, and I look forward to seeing you soon.